Today, we're cracking open a time capsule. But this isn't some dusty piece of history. We're diving into Warren Buffett's 1996 letter to shareholders, and let me tell you, it is an absolute masterclass in creating value. We're going to pull out the timeless lessons that are just as critical for a professional investor today as they were back then.
So let's start with the headline number from 1996. Berkshire Hathaway grew its per-share book value by an absolutely staggering 31.8%. An incredible number, right? But here's the thing. If you think that's the real story, you're missing the entire point. That number, it's just the tip of the iceberg.
And there you have it. From the man himself, this one sentence. This is the key. It's the Rosetta Stone that unlocks his entire way of thinking. It's a direct challenge to how most people look at accounting, and it's the foundation for everything we're about to talk about. The huge difference between what something costs on paper and what it's truly economically worth.
So, here's how we're going to break this down. We're going to tackle 6 core ideas from the letter. We'll start with that concept of value itself. Then we'll look at how Berkshire is structured, how Buffett actually buys businesses, his unique take on risk, his philosophy for the stock market, and we'll wrap it all up with the most important part, the mindset of a true business partner.
Okay, first up, the absolute bedrock of the entire Buffett approach. Before you can even think about investing like him, you've got to learn to see value through his eyes. And this isn't just some academic theory. This is the practical lens he uses for every single capital allocation decision.
Now here's what's so important to get. Intrinsic value is not a hard number you'll find on a balance sheet. It's an economic estimate. It's a judgment call. It's all about the future cash a business can generate, not the past. And Buffett's point is that this is the only logical way to figure out if an investment is attractive, because that's what you're buying, a claim on all the cash that business will produce for the rest of its life.
And this is where it gets really interesting. Buffett flat out said that in 1996, Berkshire's book value dramatically understated its true intrinsic value. So why was there such a huge gap? Well, because the amazing businesses he owned, like See's Candies, were sitting on the books for a tiny fraction of their real economic worth. For an investor who can see that gap, who can think like an owner, that's where the opportunity is.
So let's see how Buffett actually puts this into practice. He doesn't just talk about value in the abstract, he gives us a framework for analyzing it even inside a beast as complex as Berkshire. He basically splits the company into 2 different value-creating engines.
Take a look at this. This is the table he actually put in the letter. That first column, that's the investment portfolio, all the publicly traded stocks they own. The second column is the pure earnings power of the businesses that Berkshire owns outright, separate from the investments. By splitting them like this, you get a much clearer view of how and where the value is really being created. It's a really powerful way to analyze any company, frankly.
But there's a third element, kind of a hidden turbocharger for this whole engine. Insurance float. You know, this is Berkshire's secret weapon. It's a giant pool of money that they get to hold because they collect insurance premiums up front, but they don't have to pay out claims until much later. It's effectively a massive loan from their policyholders.
And this is where the magic really happens. If their insurance businesses are run well enough to just break even, the cost of all that money, that float, is 0. But for Berkshire, it was often even better than that. They often ran an underwriting profit, which means the cost of their float was negative. Just think about that for a second. They were literally being paid billions of dollars to hold and invest other people's money. That is the rocket fuel that powered decades of compounding.
Okay, so we know how he thinks about value. How does he actually put all that capital to work buying entire companies? You know, you might expect these incredibly complex financial models, but the reality, it's all about simplicity and focusing on business fundamentals. This story from the letter is just perfect. There was no investment banker, no big auction, no army of analysts. It was basically a conversation at a party that led to a deal. Why? Because he had done his homework for decades. He already knew it was a great business run by people he trusted, so when the opportunity came up, he could act decisively, practically overnight. The lesson is that preparation is what lets you seize those moments of luck.
So if you boil these stories down, you get this incredibly simple but profound checklist. And notice the order here. It starts with the quality of the business and the integrity of the management. Price is number 3. It's important, but only after you know you're buying a great company with great people. And of course, the last one is key. He only buys things he can actually understand.
Next up, let's look at one of Berkshire's most unusual businesses, super catastrophe insurance. Now, this is more than just an insurance operation. It is a masterclass in how to think about and actually profit from extreme, unpredictable risk. And that is a vital skill for any investor.
This quote just says it all, doesn't it? It is pure realism. He doesn't waste a second trying to predict when the next giant hurricane or earthquake will hit. He just accepts that it will happen. It's a certainty. And he prices his insurance policies with that inevitability baked right in, making sure that over the long run, the good years more than pay for the one terrible year that he knows is coming.
And this chart perfectly illustrates that mindset. He says, point blank, that he would much rather earn a lumpy 15% than a smooth 12%. Now, this is a direct shot at Wall Street's obsession with smooth, predictable quarterly earnings. For Buffett, short-term volatility isn't risk. It's the price you have to pay to get superior long-term returns. He's happy to pay it.
So let's shift gears from buying whole companies to buying stocks in the public market. You'll see his approach is almost exactly the same. He's not buying tickers on a screen, he's buying pieces of businesses. Specifically, he's looking for what he calls the inevitables.
So what on earth is an inevitable? Well, it's a business with a competitive moat that is so wide and so deep that its future dominance is almost a foregone conclusion. Think about Coca-Cola or Gillette back in 1996. Their position in the world wasn't just likely to continue, it was almost certain to get even stronger. He's looking for that kind of predictable long-term strength. And here's his advice boiled down into 4 simple rules. It's all about discipline, it's about concentration, and man, is it about patience. But that last line, just let that sink in. If you aren't willing to own it for 10 years, don't own it for 10 minutes. That is such a powerful filter for cutting through all the short-term noise and focusing only on businesses with real, durable competitive advantages.
And finally, we get to the big one. This is the overarching philosophy that ties all of these pieces together. It's the mindset that changes investing from a game of numbers on a screen into a genuine act of business ownership.
Look at these principles. This is the deal, the social contract between Buffett and his shareholders. It's about alignment. They eat their own cooking, so management's financial fate is tied directly to the stock. It's about discipline with capital, never ever issuing stock for less than it's worth. And it's about total transparency. His goal is to tell you what he'd want to know if he were in your shoes. So when you buy a share, you're not just a stockholder, you're a partner.
And really, that leaves us with this one simple, essential question you have to ask yourself. All the lessons from this 1996 letter are pushing us to look past the ticker symbols and the quarterly earnings circus. They challenge us to think like owners, to focus on the long-term economic reality of a business, and to decide for ourselves, are we just playing the market, or are we truly building wealth by owning pieces of exceptional businesses?